Here is a number that will change how you think about your home forever. If you bought a $300,000 house with a 30-year mortgage, you will actually pay back close to $600,000, nearly double what the house cost. And most people have absolutely no idea. Today, we are going to break down exactly how that happens. And more importantly, what you can do about it. Let's start with the most important concept nobody teaches you in school: amortization. When you take out a mortgage, you agree to pay back the loan in fixed monthly payments. Sounds simple. But here is what the bank does not highlight in the brochure. In the early years of your loan, nearly all of your payment goes toward interest, not the actual balance you owe. Here is a real example. Say you borrow $300,000 at a 7% interest rate. Your monthly payment is about $1,996. In your very first payment, $1,750 of that goes to interest. Just $246 chips away at the actual loan. After 12 full months of payments, you have paid almost $24,000, but reduced your loan balance by less than $3,000. Banks structure it this way on purpose. It is called front-loading the interest. They collect maximum profit while you are most likely to make consistent payments. By year 10, you have paid over $230,000 in total payments, and still owe $262,000 on the original $300,000 loan. You have barely scratched the surface. This is not some conspiracy. It is just math. But understanding this math is the first step to fighting back. Now here is where things get really interesting and potentially life-changing. What if you made just one extra mortgage payment per year? Let's go back to that same loan, $300,000 at 7% for 30 years. Without any changes, you pay $418,000 in interest over the life of the loan. That is on top of your principal. But if you make one extra payment every year, either as a lump sum or spread across your 12 monthly payments, the math shifts dramatically. You would pay off your loan almost 5 years early, and you would save over $68,000 in interest. $68,000 from one extra payment a year. Take it further. Make bi-weekly payments instead of monthly. Because there are 52 weeks in a year, bi-weekly payments equal 13 full monthly payments instead of 12. Same savings, naturally built into your schedule. Some banks will try to charge you a fee for this. Do not pay it. Call your servicer and ask how to apply extra payments directly to the principal. They are required to tell you. The banks will not advertise this because it costs them. But this single strategy, paying extra toward principal, is the highest guaranteed return on investment most homeowners will ever make. Refinancing sounds like a magic solution. Lower interest rate, lower monthly payment. Who would not want that? But refinancing has hidden costs that most people overlook completely. When you refinance, you are taking out a brand new loan to replace your existing one. And brand new loans come with closing costs, typically between 2 and 5% of your loan amount. On a $300,000 loan, that is $6,000 to $15,000 in upfront costs. Here is the key number you need to calculate before refinancing, the break-even point. If you save $200 per month on your new payment and your closing costs were $6,000, divide $6,000 by 200. That is 30 months, 2.5 years, before you actually start saving money. If you plan to sell or move in the next 2 years, refinancing will cost you money, not save it. But there are times when refinancing makes perfect sense. If interest rates drop significantly, say from 7% to 5%, the savings can be enormous. If your credit score has improved dramatically, you might qualify for much better terms. Or if you want to switch from a 30-year to a 15-year loan to build equity faster. The golden rule: refinance for the rate, not the monthly payment. Banks love to show you how much your payment drops, but they often do not show you how much longer you are now paying or how much more interest you are accumulating over time. When you got your mortgage, you probably focused on the interest rate. That makes sense. But your interest rate is just one piece of the total cost of home ownership. Let's talk about the fees hiding in plain sight. Private mortgage insurance, or PMI, is required if you put down less than 20%. It can cost between 0.5 and 2% of your loan amount annually. On a $300,000 loan, that is up to $6,000 per year. And it does not go toward your loan or build your equity. It protects the lender, not you. As soon as you hit 20% equity, request its removal in writing. Origination fees, discount points, title insurance, appraisal fees, application fees, home inspection. These costs can add $5,000 to $15,000 before you make a single mortgage payment. Then there is escrow. Most lenders require you to pay property taxes and homeowners insurance through an escrow account. This sounds convenient, but it means the lender holds your money interest-free until the bills come due. You are essentially giving them a free float on your tax money. Understanding these fees does not mean you should avoid buying a home. It means you should go in with your eyes open, negotiate where you can, and never assume the first offer you receive is the best one. This is one of the most debated topics in personal finance, and the answer is not as simple as most people think. On the surface, a 15-year mortgage seems clearly better. You pay far less interest over the life of the loan, you own your home outright in half the time, and you typically get a lower interest rate, often 0.5% to a full percent lower. Let's look at real numbers. Same $300,000 loan. At 7%, a 30-year mortgage costs you $418,000 in interest. The same loan at 6.5% for 15 years costs just $166,000 in interest. That is a $250,000 difference. But here is the other side of the equation. The 15-year monthly payment is roughly $2,600 versus $1,900 for the 30-year. That is $616 more per month, every single month. For many families, that difference in cash flow is not optional. That $616 might be the difference between making ends meet and falling behind. The smartest approach? Take the 30-year loan, giving yourself flexibility, but make extra principal payments whenever your income allows. You get the safety net of a lower required payment, but you can aggressively pay down the loan when times are good. Here is the truth about mortgages. They are not designed for your benefit. They are financial products optimized for the lender's return. But knowledge is your most powerful tool. If you take nothing else from this video, remember these 4 things. Understand your amortization schedule. Know how much of each payment goes to interest versus principal. Make extra principal payments whenever possible. Even small amounts compound into massive savings over time. Before refinancing, calculate your break-even point. Refinancing for a lower rate can be powerful, but only if you are staying long enough to recoup the costs. And read every fee on every document. Ask questions. Push back. Negotiate. Your mortgage will likely be the largest financial transaction of your life. It deserves your full attention. If this video helped you understand your mortgage better, please subscribe to the Loan Desk. We cover mortgages, refinancing, and personal finance with real numbers, not vague advice. Hit that like button, drop your questions in the comments, and we will see you in the next one.